Hi, everyone. Thanks for joining our E3 webinar today. We'll be presenting on the state of the California market and insights for California Community Choice Aggregators, or CCAs. My name is Emily Rogers. I am a managing consultant in our asset valuation practice area, and I've really enjoyed supporting multiple CCAs over the past few years and thinking about core CAISO market dynamics, especially from different developer perspectives, and working on a lot of storage revenue forecasting. I'm joined by Asset Valuation Director Nate Miller here in our San Francisco office. He'll introduce himself.
Hi, everyone. It's nice to be with you here today. And thanks, Emily, for putting this on. I'm excited to talk to you all about what we're seeing happening in the California market, and I look forward to some discussion at the end.
Awesome. We'll go ahead and dive in. So in terms of contents today, I'm going to share a little bit about E3 in case this is the first time we're meeting folks, and some of our core services for CCAs that you may be interested in. Then I'll share some state of the California market insights, especially from 2024 and this year to date, relevant to CCAs. Then Nate will cover navigating future uncertainty, and we'll close with some question and answer time. Please feel free to use the Q&A feature within WebEx to add your questions, and we will get to them at the end. And this meeting is being recorded. Great, well, I'll go ahead and dive right in. So who is E3? We are Energy and Environmental Economics. We are an energy consulting firm based in San Francisco with offices across the US and also in Calgary, Canada. We have over 130 full-time consultants, and we support a really wide range of clients, from utilities, system operators, and CCAs, to private clients, including investors, resource developers, and asset owners, to public clients, including nonprofits and universities. We complete over 300 projects per year, which gives us a really unique perspective in understanding all of these different client perspectives and markets. Here on this slide is a few recent examples of E3 projects. In our asset valuation practice area, we support billions of dollars of capital deployment, different market price forecasting, as well as transactions. We also have an integrated system planning practice area that does the CPUC IRP and supports utilities across the country in understanding which resources to add and capacity markets and market design. And lastly, we have a climate pathways and electrification practice area that thinks about long-term trends in our emissions reduction and decarbonization. I wanted to highlight some relevant E3 services, and please feel free to follow up with myself or Nate after the webinar if you have any interest in discussing further. Our emails are on the last slide of this presentation. But a lot of people aren't aware that we produce a really detailed market outlook for CAISO and the broader WECC, including the Pacific Northwest and Desert Southwest. This comes from our detailed look at loads, including kind of baseline residential, commercial, industrial loads layered with interesting trends in electrification for transportation and buildings, and data centers and large loads, which gives us a really robust view of future loads over the next 30 years. On the supply side, we look at interconnection queues and generators, retirements, transmission constraints, all rolled up to give us a really robust view of future market fundamentals and dynamics, which result in our wholesale market price forecasts. This includes hourly day ahead, real time, ancillary services prices. We also take a really detailed look at the California capacity market, the resource adequacy program, and produce price forecasts as well as capacity accreditation forecasts for that. We also look at the renewable energy credit, or REC market, and price forecasts. And this market outlook informs all of our strategy engagements with CCAs and others thinking about how to approach the market, and flowing into the rest of these sections. So second is bid evaluation. E3 and myself have really enjoyed supporting CCAs with procurement and bid evaluation, as it's one of the most important kind of questions facing CCAs in the next few years. This includes asset-specific cost modeling, revenue forecasting, detailed operations modeling with some of our different in-house models like Restore, and risk assessment, whether that be technical or economic curtailment or developer risk. And then thirdly, our PPA support. We've read tons and tons of PPAs. We're qualified to help structure and negotiate PPAs and provide you with insights. We also do a number of asset-specific evaluations, especially for storage and renewables. We do nodal revenue forecasting, operations forecasting, and can provide insights on kind of on-site load, hybridization, sizing, contracting. And then two categories that are a little bit separate to the supply side is E3 and at large does a lot of work on rate design, program design and evaluation. And then lastly, much more, but some that I wanted to highlight include our work in EVs. So we do EV adoption and load shapes on a really granular level. We've also looked at the value of managed charging and vehicle to grid in the future. And we produce adoption forecasts for distributed generation like rooftop solar and behind the meter storage. And lastly, we've been doing a ton of work in data centers and large loads. So I hope this provides some helpful overview of different E3 services, and I'm excited to get into some of the content of today. So I'll dive into the state of the California market, and Nate, feel free to jump in if you have anything to add. I'm going to begin with load. Over the past many decades, load in the US and California has been relatively flat, if not slightly increasing, because of energy efficiency and, not major growth. However, we are entering a really exciting new age of load growth with a significant amount of uncertainty. And this is driven by population dynamics, data centers, if you've seen kind of the many, many gigawatt forecasts nationally, which will manifest in certain pockets, manufacturing loads driven by federal policy and onshoring, electric vehicles, building electrification, and extreme weather from climate change. All of these factors are contributing to a ton of uncertainty on how much load our electric system will need to support over the coming, 5, 10, and decades to come years. We like to think about this load in different waves. So this is kind of the 3 waves of new load growth that we think of, where the wave 1 is the data center surge. These are technology companies trying to get massive data centers online as fast as possible. And while there may be kind of different levels of hype or over-optimism in relation to national data center demand forecasts, we do believe, a significant amount of this is real and will manifest in certain pockets, especially here in California or even in our backyard in Silicon Valley. The second wave we think about with load growth is electric vehicle acceleration. This load, has been coming online slowly in California and is here to stay. Whether that will be coming online quickly based on current policy or if those policies will change is yet to be determined. But we do believe this load is going to keep increasing in a real way. And beyond EVs and data centers, US industrial policies supporting onshoring of manufacturing, especially in the Southwest and Southeast, are bringing on a lot of industrial loads. And lastly, kind of in wave 3, in addition to those industrial loads, are a ton of electrification of everything. So this is all of different types of residential appliances, including heat pumps and stoves and all of that good stuff, which will put a ton of new load from fuel switching on our electric grid. And on the right-hand side is E3's forecast for new loads in CAISO and terawatt hours. You can see our baseline is 30 terawatt hours in 2035. And on top of that is, almost 70 terawatt hours coming from these electrification loads and 10 coming from data centers. So a really significant portion that we have not had to consider and plan for in the past. And one more piece of this load that I want to dig into is the electric vehicle portion. We think this is a major driver of significant new load with significant uncertainty due to the new federal administration and their focus on California Advanced Clean Cars 2 standards. So what I'm showing here is kind of E3 forecasting of ZEV share of total stock and some of our kind of broader calculations, which is by 2050, EVs could reach 144 terawatt hours, which is 27% of California load, even if EVs are only 50% of on-road vehicles. So, regardless of the standard, if we think about EV adoption becoming a really big part of the vehicle stock, this is going to have major impacts on our electricity grid. Right. So that's what we had on load. Now I'm going to think about supply and how we meet all of this new uncertain load. So CCAs have been helping California exceed its clean energy targets in big ways. On the left-hand side here, I'm showing CCA development. So online generation in blue, under development resources in orange, expiring contracts against California's Renewable Portfolio Standard Need, or RPS. As you can see, CCAs have already enough resources under development to meet California's 60% renewable portfolio standard target by 2030, which is really exciting and something that should be celebrated. However, the California market as a whole is close to meeting the 2030 target, but not quite there yet. On the right-hand side, when we add in the investor-owned utilities and other ESPs, you can see we are short for 2030, but coming up. And this is one of my favorite slides on California's evolving grid. This shows resource additions from 1995 through last year. And so I want to walk through kind of the different resources that have been contracted to be able to meet this standard. You can see that there were not many resources added prior to 2000. And after the California energy crisis, we had a huge boom in natural gas generation build from 2000 to 2010. This was also a time of resource adequacy surplus, as well as the birth of the resource adequacy program. This was followed by 2 years of big wind installations in 2011 and 2012, which really transitioned to more of an era of solar installations. This was driven by the new renewable portfolio standard policies, as well as cost declines. And the big headline in the last 5 years have been the quantity and speed at which batteries have come online to the CAISO system. And this has been driven by project economics as well as resource adequacy procurement orders. And this boom in batteries has been really impactful in big ways. When we had 2022 summer events, we saw a little bit of contribution from batteries. And last summer, when we had, closer, hotter days, we saw, even more batteries contributing to supporting our peak load in summer. So that was the installed gigawatts resources. How does that translate into actual generation? This is 2024 average hourly generation by resource. And what this shows is for each month, the average 24 hours daily generation. So I know it's kind of a busy chart, but when we think about the daily load shape, kind of the morning peak and then larger peak in the evening, it's interesting to see how different resources are contributing. And 2 takeaways from this slide. The first is that in 2024, CAISO reached 51% renewable portfolio standard, which is really exciting. And the second is some observations on the thermal fleet. So if we look at the chart kind of building up from the bottom, nuclear is behaving as baseload in orange. And then at the top, we have different renewable resources, including solar in yellow, wind in purple, and green for other renewables. And the variability in those is really large between, July and January. And it's also varied throughout the day. And so the amount that the thermal fleet has to provide in April, for example, in aggregate, and also the difference between the lowest part of the day and the highest part of the day is wildly different from July, where they're providing a significantly higher amount of generation in total, and then also how much they have to ramp for that peak demand in the evening. And this is a really important and interesting question for us to think about, because as we transition to a more fully decarbonized system, we have to think about, will this thermal fleet, what resource will it be? Will it be a clean fuel? Will it be a long duration storage technology? and it's an important consideration in thinking about future contracting and the future of our CAISO supply. And an important part of this picture is also wind and solar curtailment. So here we have been looking at the state of the market in terms of the full year of 2024 and then also 2025 through April. As you can see, solar production is shown in the bars in yellow, so definitely highest in summer, where solar curtailment in the dotted line is higher in spring. So we saw 19.4% curtailment in spring, peaking last year, and then this year we saw 21.7% curtailment, which is a major factor in consideration, especially for procurement. Wind, we see a little bit of a different story where wind curtailment is still highest in spring months, but it's very, very low in summer because of those complementary generation shapes. So for last year, we saw 13.7% solar curtailment, January through April, and this year we've seen very similar to date so far. And related to wind and solar curtailment, I'd be remiss if I didn't talk about negative energy prices and RECs. So this slide, while busy, I'll take a moment to dig into. California in general has been seeing deeper and more frequent negative energy prices in the day-ahead market. We have also, in turn, been seeing deeper and deeper, or higher and higher REC prices. So in 2021, you can see this is showing the 3 zones of California for NP15, SP15, and ZP26, and a solar REC price at $12 per megawatt hour. Those have increased from 2022 to 2024 as negative prices deepened. If we think, if we put ourselves in the mind of a developer for a moment, they're thinking about having their solar asset. If the energy price is at negative $10 per megawatt hour and they earn $12 for a REC, they will generate and earn the $2 per megawatt hour. However, if the energy price is negative 20 and they only earn 12 for a REC, they will choose to curtail. So this is a really important indicator of what we're seeing in trends in curtailment and energy and REC pricing. REC prices in 2024 have been observed between $30 and $80 per megawatt hour on the far right side. Great, and then the last trend I wanted to talk about with the state of the California market was storage. And this is our daily 4-hour spread of day-ahead energy prices. And this informs storage revenues for a 4-hour battery. This is similar to a top-bottom calculation if you're familiar with that. And you can see that 2022 was peak day-ahead 4-hour spread. And since then, we've been coming down off of that to about $60 per megawatt hour. And interestingly, while you may assume that the 4-hour spread is highest in summer months, we have also seen local peaks in winter months over the past few years. And E3 is actively updating this to the last month of this year as we inform our big refresh of our storage revenue forecast for CAISO, which will be coming out in July. Great, and then that was supply. So now I'll share a few more slides on procurement before I hand it over to Nate. So more resources are needed to meet California's goals. The CPUC adopted a carbon emissions target of 25 MMT by 2035. And this is going to require an additional 50 gigawatts of clean resources by 2035. The chart I showed you earlier ended in 2030, which was the good news that we're on track to meet that, but there's still a lot of work to be done. And especially by 2045, we're projecting you need 110 gigawatts to be able to meet that goal. And when we think about the role of the CCA today, we think of them as friendly hometown service deliverers and local providers with great relationships with customers. But we also think of them as cold-blooded commodities traders, or that should be the goal. And this slide is mostly a joke. But when we think about how CCAs can best serve customers. This is one of the core ways, making really smart and strategic procurement decisions in the wake of tons of uncertainty in the California market in order to bring those resources online and meet our decarbonization goals. So now I'll pass it over to Nate to discuss some of those important trends.
All right, thanks, Emily. So let's first talk about the 800-pound gorilla that's sitting out there beyond the CAISO border, or in part in the EIM right now, which is the regionalization of markets and the choice that many utilities across the Western U.S. are making in today and in the coming say 24 months between the CAISO's expanded day-ahead market, the EDAM, and the Markets Plus framework that is being offered as a service by SPP. So how do we think about this? Well, in a broad picture, as I think many or all of you are quite familiar with today, the energy imbalance market, the real-time market that's been run by CAISO, has been very successful in allowing efficient real-time prices and real-time trading by a very broad swath of participants across the West. And the EIM has delivered hundreds of millions of dollars in benefits to its participants. And as the two different extended day-ahead market regimes from CAISO or SPP are being considered by utilities, where different utilities land and who goes which direction is going to have very material impacts on power flow trading and the prices of trading, including trading patterns across the West. This is something, a topic that E3 has been very intimately involved in as an advisor to many of those entities, evaluating their options. And what we observe that I want to bring to the table here for all of you, of course, is that first, as a core principle, a day-ahead market is expected to have a larger share of potential benefits relative to a real-time market because there's a larger volume of power that can be optimized in this footprint. Also, as generally is the case with markets and fundamental load resource diversity, is the larger the footprint, the bigger the pool of total benefits to participants. That often means, the rising tide lifts all boats, that those benefits are accrued and captured by all participants, but it's certainly based on the nature of individual participants, not uniform how those benefits are distributed. It really depends on whether you are a net exporter, a net importer, and how that is slated to evolve over time. So the main point I'll leave you all with for now is that while this is an active ongoing effort by utilities to stand up and join these markets that will have impacts through the next couple of years, we'll start to really see them, I think, in 2027, 2028, as these markets are operationalized. Certainly, many of you are familiar with the Pathways Initiative for CAISO governance reform. That is a material factor, perhaps, in some entities' willingness to join the EDAM market in the next few years. And that is still very much an ongoing policy debate and effort right now. The broad takeaway is if more folks join the CAISO EDAM market, it will be better for CCAs, for all load-serving entities in California. And that's a pretty robust finding from E3 analysis. And as we see markets like the Southwest move away from EDAM and towards Markets Plus, we're expecting to see some changes to the trading dynamics there. So something else that I know everyone here is very familiar with, the central procurement orders from the CPUC for midterm reliability. I know this is something that has occupied a lot of your time and efforts on the procurement side for your operations. And so I won't spend a lot of time on this because you're all quite familiar. Needless to say, maybe just two overarching points. Number one, the midterm reliability order implementation, despite the challenges of supply chain through COVID And a lot of the delays, including some interconnection delays as the clusters have expanded, I know you're all very intimately familiar with this, has nonetheless delivered material capacity to the California grid. In other words, thanks in part to your efforts, there are a lot more resources online today, firm resources, largely battery storage, that are materially supporting grid operations. We saw that in a decrease in summer prices in 2024 relative to 2022, for example. And the system is demonstrably far more reliable today than it was 3 years ago or 5 years ago as these orders were being contemplated and executed. So there's still some more work to be done on fulfilling the mandates that have been handed down from the PUC through 2028, but the progress has actually been quite good despite the roadblocks or speed bumps along the way. So we have long had a history in California of central procurements. I could spend an hour just talking about the evolution of the resource adequacy program, and maybe that will be a future webinar that we'll do. But for now, I wanted to characterize the continuing and evolving role of the CPUC. Of course, we do work closely with the CPUC resource planning team in our contract for the state's integrated resource plan. Now, the CPUC's role over time has certainly evolved from being the regulator of retail rates in the general rate case, through to its role in resource planning and then in procurement mandates to bring resources and long lead time resources into play that were not being developed on their own by individual bilateral entities. What we see as a continuation of that trend is the proposal for the RCPPP, which is the Reliable and Clean Power Procurement Program. I think many of you are probably familiar with this proposal. Essentially, it would establish a long-term procurement framework for both clean energy and resource adequacy that would be intended to reconcile and align some of the differences out there between the RA program and the IRP. Now, obviously, this is still very much a policy in progress and a proposal, but we see that the creation of a more predictable and stable central procurement mandate, as opposed to a series of ad hoc orders, as the MTR has been, may be beneficial to the market. There are also some challenges to work through regarding, call it incentives and alignment of CCAs and other LSCs to go out and procure their own portions of the resource portfolio for capacity and RECs. And there are definitely some items that still require working, but this is a potentially impactful policy that is being contemplated. So I want to talk about uncertainty for a little bit. We definitely live in an uncertain world. And first, let's look back before we look ahead into the murky crystal ball here. So as many of you lived through, and not just remember, CCAs in the 2010s really came of age in a very particular moment in California's resource and market history. This was a moment where we were continually observing pretty material cost declines in solar and wind specifically, and solar most impactfully. I don't know, maybe it's hard for folks on the procurement line now to remember $25 PPAs for solar, but there was a moment when we were seeing, every few months a new low-cost SP15 solar PPA being signed. It's more like in 2017-18 timeframe before COVID. And in this era of kind of aggressive cost declines and great resource development of particularly solar, CCAs had a lot of opportunities to go out there and buy clean power that was a lot cheaper and pretty readily available. And there was also low interest rates for many years in this time. Again, taking a moment of nostalgia looking back versus where we are today. But it's important to understand also that we had, there were continued congressional punts of kick the can and then, re-up the investment tax credit. And that added some uncertainty to the market, but there was a lot more general stability on the federal tax and trade policy in this time frame than is evident today. So why do we look at the history of stability and declining costs? I think because everyone's probably feeling in the market right now a lot of storm clouds on the horizon, a lot of uncertainty, and a lot of major factors that have material cost implications for all of your customers and for affordability. So I could also spend many hours talking about this, but we won't today. Suffice to say, it's important, I think, when we think about and talk about the procurement of new resources to meet Californians' evolving energy needs, clean energy, capacity, load growth. We also have to look at the retail rates that Californians are paying. I'm a PG&E customer in San Francisco. I feel this with the rest of you. And obviously, California has a major affordability issue, a crisis, in fact, as rates have essentially doubled over a 5-year period. And that's been felt loudly by customers. I'm sure your customers have felt that. And that puts stress, of course, on the procurement decisions for wholesale energy, and it also puts stress on consumption patterns and on fuel switching, even towards electricity. And it's pretty important when we think about the long-term policy arc and trajectory of the resource mix in California and electrification. We'll talk about data centers again in a bit, that we reconcile that math and find opportunities in the growth of the denominator to also mitigate the increase in their rates per kilowatt hour themselves. Wildfire mitigation and damages, cost of capital, and the net metering programs have been the major drivers of this change in rates. And those are pretty thorny issues. There's a lot of great material that's been put out there characterizing the nature of cost shifts and the wildfire investment needs for mitigation and management. That this is going to be continuing to be a very important and impactful issue for California to work out. So another issue that I know you're all very close to is that resource adequacy prices have risen dramatically. They continue to be high. California is not alone in this across the country. PJM and MISO recently have also experienced very high auction prices that continued with California's are signaling and representing the fact that these systems need new resources for the first time in many decades. As Emily covered, we haven't seen load growth like this in a long time in the United States. And existing resources are reaching their limit, their ability to serve the peaks that are here and the peaks that are coming. And so as we need new resources, we need to pay for those resources. And paying for them through capacity markets and contracts has been a pretty critical revenue stream and means to do so. At the same time, that, of course, as you all know, puts pressure on the allocation of those costs to customers and continues to trigger healthy discussions on how to manage the costs of new entry and new resources, as well as the retaining existing resources into the future to maintain reliability as the system evolves. But unfortunately, as I know you're also very familiar with, it's not just RA prices that are very high. PPA prices in California are also particularly high, and they are elevated across the country right now. This is a continuation of a trend that really started kicking up during the supply chain disruptions of COVID in 2020 and 2021. Higher interest rate environments have continued to push up PPA prices, and at the same time, increasing commercial risks and interconnection costs have all fed and fueled this increase in PPA prices, where we could fondly remember the days of $25 record-setting solar in Southern California. We are now at $50 to $60 or north of $60 for SP15 solar PPAs. Again, as I'm sure you're all very keenly aware of. We don't see this, unfortunately, being mitigated anytime soon. It is certainly possible in the longer arc of procurement in the next decade or so that we could find ourselves back to a low cost, much more affordable, sub $30 price if solar in the market. But a number of factors have to coincide to get there. And unfortunately, I think the way we see the market, there are more headwinds than tailwinds in that direction. Federal policy, the possible repeal of the investment tax credits, production tax credits from the IRA with the bill in Congress right now. Additional action by the administration that could increase further costs from uncertainty, deliverability, and just simply tariffs tagged on imported modules and equipment. All of that is stressing prices, and of course, continued elevated interest rates and cost of capital, in addition to commercial risk and interconnection costs, are all very real pressures facing new resource development. At the same time, solar and wind are not isolated in bearing those increasing costs. At the same time, new gas turbines are at all-time highs. We personally, in our work and in my work, I have seen new build gas quotes and costs from clients across the Western US and across the country, where we used to have a very stable, 1,100 a kilowatt overnight capital cost, EIA kind of estimate for a new gas turbine, is now at 2,000 or even 2,500 or north of that per kilowatt. So there are elevated price pressures across many different resources at the moment. At the same time, that load is growing and more resources are needed. And that brings kind of a twin challenge to all market participants and load service entities like yourselves. So just as an illustration, one of the, we use many tools at E3. Are probably known for our models, but hopefully also for the way in which we use them. So this is just a snapshot from our discounted cash flow levelized cost model that we use to produce a lot of the cost inputs and understand, essentially synthetic PPA prices, what the cost of new resources looks like and how that can change from various factors. This goes into our capacity expansion models like Resolve and Plexos and feeds into our markets work and informs our REC pricing and RA pricing as well. What we can see here is just the impact of sort of one case of the expiration of the IRA. And if it were phased out in 2032, so that it were fully phased out by 2035. And you can see roughly that we can see a solar cost decline curve, all else equal, through 2033. But then as you lose the production tax credit, we see prices roughly doubling. It's quite impactful for high capacity factor Southern California or Southwest solar. And so we're keeping our eye on that. This view of an earlier expiration is going to be one of the core sensitivities within our new market forecast. We have to reflect the political reality that we live in and helping our clients understand the market and where things can go. And we do see a strong potential for elevated REC prices in particular as a result of this potential federal action. So I want to talk about something that I think you're all familiar with in your individual procurement needs and service territories here, which is just the net load shape that we're all trying to meet in California and how that can evolve over time. And this kind of goes back a little bit to what Emily was describing, providing an overview of 2024 actuals. I always like to look at actuals to act as a benchmark, an anchor point for expectations about the future and how things may evolve. So here we can see a 2023, this is actual historical gross California load on average, so 24-hour average over the course of the year. And if you subtract the average hourly production from renewables, wind and solar, you get the 2023 net load shape. And then by 2030, as we are adding a lot more solar, we've already crested 20 gigawatts of solar on the system today, and more is coming, and a lot more is coming behind that, as you all know. That's going to drive the average around the clock, midday loads almost to zero by 2030. And that is going to leave the rest of the resources and the need for those resources to be dispatched really in the overnight hours. If we were to not build anything past 2023, just for illustrative purposes, you can see that the 2023 resources net load shape is much more elevated by 2030, reflecting the gross load shape change, including a bit more midday air conditioning loads that I know many of you in the hotter areas of the state, and even areas that didn't used to be as hot, which now are hot, are experiencing and hearing from your customers. So when Emily mentioned that part of load growth is extreme weather, it's not even just extreme weather, it's changing average seasonal conditions. Again, I'm a long-term Californian. I grew up in the East Bay, and where I did not have air conditioning growing up. And my father installed air conditioning because the house was unbearable in the summer now. Things have definitely changed within our lifetimes, and we are seeing that happen on the electric sector. To 2040 and 2050, if we follow the addition of electric vehicle loads represented here, as well as additional data centers and core customer class growth, we can see that that net load shape continues to be more of a duck that becomes much less of a duck with a head and more of a U shape over time. And that seems to be the sort of stable projection of our expectation of the load to be served by hydro, geothermal, storage dispatch, and the thermal fleet as it evolves over time. And this also gives us the expectation in the future of the nature of the load shape that some other resource, the mix of other decarbonized resources to meet our state targets are going to have to serve. So in other words, your future procurement needs, in a sense, shown here. Something else I think that you're all pretty aware of, which ties into resource adequacy, is that as we and others supporting the CPUC continue to model reliability challenges and how they evolve in California over time, we are consistently seeing a need for resources that can be dispatched over a longer period. In other words, the critical peak period, which are hours with a high expectation of loss of load probability or an expected unserved energy in the system. By 2035 are 8 to 10 hours and are mostly concentrated in the summertime and late summer. We see them happening in August and September here in this chart, which is month by 24 hours represented. On the right-hand side, only by a few years later, and this is just from recent IRP modeling, we actually see wintertime conditions becoming more of a stress. And you can all understand that because today, right, the real gross load is very much a summer peaking system. That's also when we have a lot of solar output, however. And as total loads grow around the clock, especially as electric vehicle loads that are continued, people still drive through the fall and the winter time happen, you're going to end up having higher gross loads in the wintertime, but the renewable output is still much lower in winter. Fewer hours of daylight, lower generation, and that actually leads the system to feel more stress, even though as a state level, it's not like, California gets that cold. It's more that the generation resources that we're bringing on have more struggle meeting sustained overnight loads as the load levels rise in the wintertime. And so this all points to resources, a long duration storage, and other resources that can be net energy generating for sustained periods of time in order to meet the reliability conditions and targets that we want to maintain. This will be a quick slide, as sometimes you have to just laugh into the abyss a little bit, I guess. Needless to say, it is pretty uncertain and somewhat chaotic what we are observing now from federal action, inaction, or reaction, depending on the day. And that just makes for a challenging environment to make sustained investment decisions around. Thanks for the animations there, Emily. So, want to leave you all with some closing thoughts, and then we'll have about 10 minutes to go through some questions. I see some questions in the chat. So number one, California and you all have done a pretty amazing job of contracting new resources to the grid to meet growing renewable energy targets and goals and requirements, as well as capacity. The California grid is in a better place today than it was 5 years ago. But as you all know, we're not over the hill. There's still a long ways to go down the road. A lot more resources still need to be procured, and as the nature of loads and reliability risk changes, the nature of what those resources need to be and do will also change. Of course, that's why we do the modeling that we do. It's why we run our market price models, as well as the integrated resource planning model and our loss of load models, to understand how different drivers, such as electric vehicle adoption, data centers, will change those needs, and what resources start to make a lot more sense to be considered in the future. However, as we also need to grow the pie, the size of energy, and the nature of what resources are available when, there are continually affordability concerns. How can we maintain energy costs in total monthly household energy costs, really? And we can think about both sides of the equation. That's gasoline and other alternative fuel consumption for transport. Whether that's transitioned to electricity, then it's about total household budgets. How much are Californians needing to spend on energy as we are changing end use consumption and supply over time? And that's going to be a continued challenge. How we deal with wildfire costs, who pays what, how those costs are allocated, and where funding comes from, and NEM, those are all still major challenges to be continually addressed. And I also just want to leave you with just a bit of a note that, again, the CCAs collectively have really risen to the challenge of procurement. You brought a lot of resources online, and I think that you are probably all feeling the continued pressure to exist in that dual personality space of the local delivery service, strong customer relationships, and the cold-blooded commodities trader that Emily talked about. Because the reality of it is there are a lot more dollars and cents and risk-adjusted decisions that you all need to make in the future. Certainly, we hope that this has been helpful and that we and others out there can continue to support you in the work that you're doing. So I think at this point, I'll transition to some questions that we have from the chat. First one at the top here it's a great question. You've heard that nobody's building data centers in California because California is expensive to build. Definitely true that California is expensive. At the same time, we have heard that there are real new data centers being built around the state. There are a couple aspects to why folks are still citing data centers here. And I'll just kind of tick through the things that we're considering as we look at data center forecasts. Number one is that, yes, while retail rates are expensive in California, renewable energy has historically not been as expensive as it is in other parts of the country. That is being tested and pressure tested as we look at, MISO wind and solar prices, PJM wind and solar prices versus California or the rest of the West. But the other part is really location, location, location. We still have a large tech workforce in California. We have a lot of fiber that is delivering to customer load centers for enterprise and cloud compute that requires low latency. And so there is a locational benefit to locating data centers, close to the Bay Area or Los Angeles, major consumer end uses. We do have a lot of data centers that are still, being developed across the rest of the West, and some of those are serving California. The Phoenix area for a long time has been kind of an outsourced data center location for California, especially SoCal, and increasingly the Pacific Northwest. However, the Southwest and the Northwest are under the same pressures that California is regarding new capacity resources being required, energy being more expensive, and new transmission costs being required. So it's not like California is unique in facing some of these circumstances. And so I guess I'll leave you with California. We don't expect California to be the market that takes all the data center growth, and it's certainly not necessarily as fast moving or as large as the Mid-Atlantic, such as Dominion and AEP Ohio and those areas. But there are still material data center loads that could show up and that we expect to show up in California. Ultimately, in the long haul, I think the jury's still out, whether it will be more data centers in the near term or more EV loads. Continuing to look at those dynamics. Long term, there are so many cars on the road in California that if California is serious and then customers are serious about making that switch, it will be EV loads that are far larger than data center loads. That will be the tail that wags the dog. So the next question we have is on solar and wind PPA prices. Yes, so you're right in that the contract prices we are listing are offered prices from Level 10 Energy, which is a matcher between they produce a market index, and they also take bids from offers from developers and match them with buyers. We have seen executed PPA prices in our transaction advisory work and diligence support on both the buy and the sell side here, and we have seen elevated PPA prices themselves. So I think we want to just take any market data always with a grain of salt, but we are still seeing elevated rec prices and elevated contract prices for new offers. Let's see. Okay, so we have a question about the net load shape and the evolution and how we see solar curtailment in the future. It's a great question. We have done a lot of modeling, capacity expansion through our integrated resource plan support for the CPUC. And also Emily and I have been involved in a lot of our production cost modeling and market modeling using Plexos ST, which is dispatching different portfolios against our California loads. That helps us understand the shape and nature of curtailment patterns in California and the West over time. What we've seen as a consistent takeaway or conclusion from that modeling is that, obviously it's a cost model. So if battery storage is really cheap, you build a lot more of it, it reduces curtailment. There is, a couple different factors that make a difference. But on the whole, we tend to find that solar curtailment on an annual average, it doesn't generally go beyond 10% or so. It's about 6% today. So we think on the whole, there's likely going to be some increase, some uptick in solar as more solar is added. Now, that is predicated upon portfolios that also bring in more out-of-state wind resources over the long haul, from Wyoming and New Mexico, and that helps to balance the renewable energy, where you're getting those RECs from. And so there are a number of factors that can change and move that needle. But of course, if you have less wind, you'll need more storage to shift the solar to actually meet your net loads. And if solar becomes consequently really cheap, but batteries become very expensive, then it's going to be cheaper to build the solar and let yourself curtail more of it than to actually spend a lot of money to preserve it. So that's going to be the fundamental economic trade-off that we are continuing to evaluate over time. But I would say that we do expect in the long haul, on an annual average basis, again, springtime is still going to be 20-25%, at least of solar curtailment lost. But in aggregate, because of the summer month load shapes, probably, on the order of, say, 6 to 15 and more like 10%. Okay, we have a question about projection of increases in the PCIA due to a decline in RA costs. Excellent. Well, essentially it's a question around the projected resource adequacy prices in the market. We do a lot of this work. We have certainly seen the high water mark of the market index of $40 a kilowatt month, which is pretty staggering for resource adequacy. Certainly staggering given the history of prices, which have typically been $3 to $7 a kilowatt month over the long haul. How fast and will we return to those levels, or just more, call it $10 to $12 prices? I think that the glib consultant answer is our new forecast is coming out in a couple of weeks, and we'll have an update there. I think in general we see a decrease in RA prices, an easing of some of the pressure in the system. However, I want to mitigate that with the expiration of the tax credits under federal policy could really increase the cost of storage and the carrying cost of storage in the market. And so I view a scenario in which that occurs may not ease the pressure as much as we would all like. So there are a couple of major factors there that could influence that.
Great. Well, that looks like questions in the chat. I want to thank everyone for joining today. It was great to have you. Please feel free to email Nate or myself. Our emails are on the screen now if you'd like to continue the discussion, or if we can help support you or your CCA based on the services I shared earlier. And we hope you have a great rest of your day.
Thanks, everyone.